Gold and silver should not be traded. They should be accumulated slowly. So continue doing that and be serious about it. It's not a game, even though it's a game. It's not really a game. It's scary.
Rafi Farber discusses the existence of extra money in the system and why it costs more money for banks to administer cash than it is to give it back to the Fed. He also talks about how banks give extra reserves back to the Fed and how the money is being employed by money market.
I don't have the perfect answer as to why exactly it even exists. It's hard to wrap your head around the fact that there's so much extra money in the system that it costs more money for banks to administer that cash than it is to just give it back to the Fed. And why exactly that is, it's hard to say, because that's the reality of it. It does cost money to administer cash even. Everything costs money. Even cash itself costs money. Instead of just holding that cash, the banks, mostly the commercial banks that have all these extra reserves, they just give it back to the Fed, and the Fed gives them interest on it to keep that money out of the money supply. That's all the extra hangover dollars that were never put to use. So they just go back and forth between the Fed and the banks every night, and the commercial banks. Now it's about $2.3 trillion. I only realized this recently, but most of that interest, most of that money is being employed by money market funds. You know, typically a brokerage, if you have a cash balance in your brokerage account for trading stocks and stuff, it's going to be in a money market fund. Your broker will offer you cash. Will offer you interest for the cash that you hold in your brokerage account. And I got like several emails from my broker telling me to take all of my cash, any extra cash I may have in a deposit account in a bank somewhere, and give it to them because they can give me interest 0.5% lower than the Fed offers them at the reverse repo facility. So they're saying it out loud that this cash they're going to put in the reverse repos, they're going to put in the money market fund for me, and then I can earn cash. So banks can't pay this interest that the Fed pays on the reverse repos because they can't afford it. They're barely surviving as it is.
Rafi Farber talks about the risks of draining reverse repos and what could happen if the money suddenly gets drained from money market funds. He also discusses how draining the reverse repos could affect the money supply and the circulation of prices.
We've heard comments from Federal Reserve officials. I think Christopher Waller was one, maybe there was another one. Relatively minor people, but the Fed puts out these trial balloons every now and then to see what the financial media will say about this or that development. If somebody on the Fed says, let's do this with the reverse repo. So there's been comments that we could just lower our balance sheet or shrink our balance sheet by $2.3 trillion and no one would notice. It would be like nothing because like this money's extra, so take it off the balance sheet and it's fine. It's not extra. People are using it like in brokerage accounts, in money market funds. So if you take that, if you suddenly drain the reverse repos, then all the money market funds, like people who have money in there, and sometimes there's like minimum, you have to eat $10,000 minimums for some of these funds. So then if some people are trying to redeem it all at the same time, then the fund collapses. And if the fund collapses, then people have fewer dollars in it, then they put more dollars in it than they can redeem, right? It's the same principle as a real estate fund can't redeem its money for its investors. You get less money than you put in, you lose it. This is what was happening in 2008 with money market funds, because back then they were invested in commercial paper. Now they happen to be invested in reverse repos, but you can't just move $2.3 trillion from money markets to deposits and say, oh, everything will be fine. Because then you have the issue of all this money gets put into the money supply, into circulation, and then what happens to prices? $2.3 trillion should do something. I don't know exactly what. That's a lot of money.
Rafi Farber discusses the recent rally in gold and its possible causes. He talks about the 8-year cycle low in gold and the foundation for it, and the possible correlation between debt cycles and gold. Rafi Farber advises keeping a keen eye on the housing market and mortgages as they could impact the dollar and gold.
I'm not sure what the cause of any specific rally is. When I hear these kinds of questions, I usually turn to the technical analysts, but not just any technical analysts. I look at the technical analysts that have the right philosophy, that understand what money is. And so they're not going to just rely on their voodoo charts or whatever, but they have a strong fundamental backing for what they're saying. And what I'm hearing is that there was an 8-year cycle low at around 1618 or 1620, whatever it was in October. And now this is a new 8-year cycle for gold. And what's the foundation for an 8-year cycle? I'm not sure. I'm not a technical trader, but it seems to fit in with the pattern of gold. And you could say debt cycles go in 7 years, 8 years, those kinds of cycles. So maybe it's legitimate. And in terms of exactly what's causing the rally now, I don't know. But I do know that gold is not going to stay where it is for much longer. It's been in this area since 2011, and we're in a much more extreme monetary situation than we were from 1980 to 2000 when it went nowhere. And now it's been like 12, 13 years. So that's almost half the amount that it's been. It was down from 1980 to 2000, 2008. And since we're in such a more extreme monetary environment, I think we're headed up from here. Exactly how fast, I'm not sure. But watch the housing market, watch mortgages. And when those buckle, the big leg is going to be taken out of the dollar, and gold is going to respond to that because gold really is the inverse of the dollar, by definition.
Rafi Farber advises investors to accumulate gold and silver slowly and to take it seriously, as it's not just a game but rather a scary situation. He notes that he's receiving calls from people who previously ignored his advice but are now getting nervous due to inflation and tech stocks.
I'm getting a lot of calls, a lot from my neighbors and from people who don't exactly prove what I say, but they're like, oh yeah, Rafi, you're right about the endgame, I understand, but it's going to be like 10, 20 years. Stop chicken littling and saying it's coming in a few months or a year or two. And now they're calling me and saying, Rafi, do you think it's okay to hold Apple? Do I hold too much Apple stock? I'm like, I wouldn't hold any Apple stock. I'm not going to tell you what to do. But now you're calling me and you're saying you're a little bit nervous. Yeah, I'd be nervous if I were holding too much tech stocks. So I'm noticing these people that blow me off, they're getting a little bit scared. And I'm getting word from my family in the States that inflation is getting very difficult for them. And I'm starting to feel a little bit of the panic from people, especially if they're not earning enough income. I don't know how much longer we have, but if you have extra cash, now is the time to accumulate more. I wouldn't wait for a pullback, is what I'm saying. Gold and silver should not be traded. They should be accumulated slowly. So continue doing that and be serious about it. It's not a game, even though it's a game. It's not really a game. It's scary.
As we come to the end of this video, I hope you found it informative and thought-provoking. If you have any thoughts or questions about the topics discussed in this video, please leave a comment below. Don't forget to like and subscribe to stay up to date with our latest content. See you in the next one.